Good morning from our global headquarters in New York. I'm Danny Berger. Manish Cranny is off for the week. Welcome to Bloomberg Brief. Let's set your agenda. The big take on Trump. The former president says if he wins, he'll allow Fed Chair Powell to serve out his term. Plus more from the Business Week interview coming up. Tougher chip curbs. The Biden administration molds the most severe trade restrictions available to crack down on chip sales to China. And stocks take a breather this morning after hitting yet another all-time high. The great rotation continues with the Russell 2000 beating the NASDAQ 100 by the most in a decade. There are so many superlatives to describe this market. That was just one of them. The other one that encapsulates this great rotation is the fact that Russell 2000 is up more than 11% over the past 5 days. S&P 500, it is up 1.5% over that time. That is the biggest outperformance on record. There are so many statistics like that. Did we get out over our skis? Well, this morning, the great rotation continues. S&P 500 futures down 0.7. Russell 2000, let's call it flat. This time, it's about the politics. It is about the Biden administration trying to crack down further on China chips. We're going to have a reporter on that in the next 30 minutes to discuss what exactly that means. But for now, it means that chip stocks tech is getting crushed this morning. NASDAQ 100 definitely underperforming. TSMC also selling off in the Asia trade. That's thanks to a Business Week interview, which we will also discuss, where Trump was a little bit more cold on the idea of supporting Taiwan because of the dominance they have in the chip industry. Meanwhile, in currency land, a lot is going on. Dollar weaker by the yen by 1.4%. A lot of people are pointing again to the politics on this. Again, our great team over at Business Week, the story they had of Trump saying that unfairly the yuan and the yen are too weak. Is that what's moving the dollar? Elsewhere, the pound also gaining a lot of steam, $1.30 versus the dollar is where cable is trading. That's because of inflation data. We've gone pricing out some of the cuts that were expected for August, only about a 35% on. It was at 50% after hot services CPI. Okay, we have to talk about this Trump story because, again, it's doing things like moving the yen and moving TSMC this morning. But first, it was former President Trump's one-time rivals coming together at the RNC to praise the nominee and push the message of unity.
Donald Trump has my strong endorsement, period.
When President Trump was in the White House, Americans had more money and lower prices. Our borders were secure and our laws were enforced. Iran was broke, the Taliban stopped killing Americans, and Putin didn't invade anyone.
Meanwhile, President Biden returned to the campaign trail as the team continues to struggle.
We have to do more. That's why I'm determined to finish this job. Look, let me tell you my 100-day agenda, and I'm not going to keep it real long. We're going to make sure you own more and you owe less.
Joining us now is Bloomberg's Stephanie Baker. Stephanie, a lot to discuss, but I want to start with the RNC, specifically Nikki Haley speaking. This was sort of the highlight. This was the punctuation mark of look at this Republican Party. It is a new era of unity. I will say she got a few boos from the audience as she was speaking. What do you make of the rivals' speeches, or one-time rivals, and whether that sort of unification message is actually playing out?
Well, I think it was notable that she actually endorsed Trump, but the Trump she was talking about was very different from the Trump that we all know. She said, I want to back a president who will take on our enemies and back our allies, and that is not the line that Trump has been taking. I think Trump's pick of J.D. Vance as his VP indicates he's not reaching out to the Nikki Haley voters at all. He's not trying to persuade moderates to back him. If anything, he's doubling down on the populist MAGA base. And, you know, I don't know how he's going to be able to expand his base. It would be a natural move for him to reach out to Nikki Haley voters.
Stephanie, we also have to talk about this Business Week story because, as I mentioned at the top of the show, it is moving markets this morning. Did we get any sort of comprehensive idea of what an economy under Trump 2.0 would look like?
You know, there's some inherent contradictions in Trumponomics that were spelled out in that Business Week story. He wants a weaker dollar, while also promising massive tariffs on not just China, but Europe, which most mainstream economists believe will only fuel inflation and in turn increase interest rates, which would in turn increase the value of the dollar. So, he's pursuing two things that are working in opposite, really, and it remains to be seen how this is all going to play out.
Well, within that, part of the sort of assumption of a stronger dollar in this is that you have more tariffs, you have tax cuts, inflation goes up, therefore the Fed needs to hike or at least cut less, therefore stronger dollar. Stephanie, the rub in that is the Fed. And Trump himself has said that he'll let Powell serve to the end of his term. I mean, how much confidence should we have in that? Again, because if he wants a weaker dollar, enemy number one very well might become Jerome Powell's Federal Reserve.
Exactly. And he just said a few months ago that he would fire Jerome Powell. So this is a reversal of that, saying that he would allow Powell to serve out his term. But given Trump's propensity to flip-flop on things, it's hard to see whether or not he'd stick to that. If his goal really is a weak dollar, he doesn't have much sway without replacing the Fed chief. So, that's one to watch for sure. But he's got a lot of different contradictions in his economic plan. A lot of them don't add up, and they fly in the face of, mainstream economic thinking.
Okay, Stephanie, thank you so much. That is Bloomberg's Stephanie Baker. She has a great podcast, and you can also read the entirety of that interview that we've been talking about in this week's edition of Bloomberg Business Week. They also have a transcript, a fact-check transcript of the whole interview. I also recommend reading that, too. A lot of things to get through and really try to understand President Trump or former President Trump and his agenda should he be elected. Speaking of which, TD Bank's Mark McCormick writes this: the rise in geopolitical uncertainty should continue to challenge the Goldilocks narrative, especially as markets have failed to price in a suitable Trump risk premium yet. I'm pleased to say Mark joins us now. He's the global head of FX and EM strategy at TD Bank. Mark, I think this is what markets are kind of struggling with. How do you actually price in that risk premium from Trump? So what should it look like?
Well, I think you highlighted a little bit before, but it looks like this. You have higher volatility, you have a stronger dollar, you probably have a steeper curve, and you have U.S. equities outperforming either Europe or Asia, particularly China. So that to me is the Trump trade. There's pieces of it. You can see U.S. equities outperforming Chinese equities since the first debate. You could see the curve kind of moving a little bit in a certain way that would kind of match some of the qualifications of that trade. But the rest of the market is really not focused on the Trump trade yet.
But Mark, this is one of those markets where it's literally choose your own adventure. You can make an argument for anything. So I'm going to make an argument for one thing, and you just tell me why perhaps it shouldn't be totally that way. The argument goes like this, that it's just the economy right now. That's all that matters, is that it looks like we're going to get a soft landing thanks to retail sales yesterday. And this is still a Fed that wants to cut. Therefore, things like a curve steepener, who cares about Trump? It's going to be put on regardless of the economy. So that's what I should concentrate on. Why do you think that's wrong? And maybe politics should come into it a bit more.
I think it's this way, too. There's like timelines to think about it. One, I think particularly for FX, I can't speak for other markets, but it's known as being a serial monogamous. So essentially, you can only focus on one thing at a time. And until it's done focusing on that thing, it can't move on to the next thing. I think the other part is it's just the timelines of things is like what we see versus what we have to think about in the future are very, very different. So the markets, it's very hard for them to be forward looking. One, because they're data dependent. So the central banks are kind of focused on the present and now. And on the second piece, there's just so much uncertainty about where the tails are on these political events that it's just too hard to trade. So I think the biggest thing that's driving the dollar right now, and the reason why it's weaker, is the thing in front of us is that the U.S. economy is slowing, but it's not falling off a cliff. It's slowing enough that gives the market confidence the Fed can cut. They basically have 65 basis points priced in for this year and almost 4 cuts for next year. So that is the most present thing that it's happening. But the other thing that's happening is the rest of the world, which everyone's focused on as a reason to sell the dollar, Europe and China improving and their economy starting to get some momentum, that is actually turning lower. So what we're starting to see is the leading indicators that we track, that we run through our models, we trade them in FX. Those indicators are now kind of nosedived in Europe and China. So the other piece of this is we know that the Fed is primed to cut. We don't know how much they will deliver. But if they don't meet market expectations now, All the forward-looking things that are happening are creating an environment that could be less positive for risk. It could be stronger for the dollar. At the very least, we should have a lot more volatility, because the one thing that we see is a tremendous amount of trade, economic, and geopolitical uncertainty, but yet no market volatility.
I think that's a great point, Mark, because, I mean, we're fully pricing in 3 Fed cuts already more than the Fed said in their last dot plot. So how much more juice is there really from that trade? But speaking of volatility, we started the show talking about the yen gaining versus the dollar more than 1%. Again, I've seen some commentary out there basically chalking this up to the interview Trump gave to Business Week, saying, look, the yuan and the yen are unfairly weak, and of course we want a weaker dollar, so on and so forth. How much do you look at that and say, yeah, there's a little bit of politics in the yen this morning?
We've been highlighting that since the intervention last week. I think an interesting part is people look at intervention and you need a fundamental misalignment. It needs to be kind of short term, and the markets need to be orderly. Essentially, the Japanese officials coming in and intervening in the yen when the dollar's already declining. Our models, which the short-term ones kind of were great at explaining prior intervention, showed no dislocation. They're actually telling you dollar yen should be higher. One thing that we saw is our positioning indicators were max short. So, maybe there's some point there that you want to squeeze people out of the market, catch them off guard, especially when everyone's in a one-sided trade. But I agree with you that I think political economy, we're calling it kind of Japan Inc. Japan Inc. being the government, the central bank, and the pension funds. Those are all the big drivers of yen. And you could argue the policies that have been put in place in Japan over the last 10 years or so has been one where it's low real interest rates. It's essentially capital flows being pushed out of Japan on an unhedged basis by pension funds, which are buying foreign assets, particularly equities and fixed income. And again, the BOJ has just allowed this to continue. So I think a big part of this is an institutional move by the entire country, by all the people who drive the currency. The government, the pension funds, and the central bank are all kind of moving in the same direction. We think the BOJ is going to hike. We've been saying it all year that they are going to hike more than the market's expecting. And the yen is now responding to this, because I believe that the one thing that I think China and Japan and other Asian currencies are worried about, and they should be because they are the most undervalued on our models, is they're worried about getting a tariff target on their back. And Japan in particular, it's the one currency it's probably, depending on your model, could be 50 to 70% undervalued. So I don't see, we see like longer term, yen, renminbi, these currencies should be stronger. Yen is more immediately. I do think the renminbi, something we can talk about another time, should be stronger 2 to 3 years out. But right now, to me, the trade is, we've been telling clients to be short euro, yen,
Mark,
on policy divergence.
Just quickly here, because we're about out of time, but on this idea that, again, part of it is they want to get it out ahead of tariffs if Trump looks at them and says your currency are unduly weak and that sort of thing. Does that mean we're kind of talking about policy errors, that tightening more, or in the case of Europe, maybe not cutting as much because they're worried about that geopolitical element?
I think in Japan, there's room to go. Like, if you think about just how undervalued the yen is, some tightening of financial conditions in Japan is not going to have a massive impact on the economy. And again, some of the indicators that we track, if you look at inflation, and again, the key thing that they were trying to do in Japan was get higher inflation to pass through the nominal wages. So they have succeeded at that. It's just that the BOJ has been kind of slow. They've been a bit sluggish in terms of moving forward. But to me, the conditions are in place for the BOJ to hike without having a massive impact on the market. And a stronger yen is not really going to have a dramatic impact on the economy when it comes to growth. So I think that's one where you could say they're behind the curve and there's a lot of room for policy move.
Mark, really wonderful to catch up with you this morning. Thanks for getting up early for us. Mark McCormick of TD Bank. Okay, let's get to some of the other top stories trending on the terminal this morning. The UK reported stronger than expected inflation in its services sector. Hello, Taylor Swift. The stickiness of the reading has prompted traders to walk back bets on the Bank of England's interest rate cuts next month. HSBC has named another insider, Georges Elderary, as its next CEO. The former CFO will take over starting September, replacing Noel Quinn, who announced his surprise decision to retire in April after 5 years in the top job. And Nomura is shuffling its Asia investment banking team. It's also cutting jobs. It's an effort to reduce costs with a deal slump in China and Hong Kong. The management change coincides with a fresh round of job cuts involving about 10 bankers this week. Okay, coming up, we're going to talk about those chip curbs that the U.S. is mulling that could hit ASML shares down 6% this morning. We're going to have more on that. And by the way, they also reported earnings next. And Blair Jacobson of Ares Management is going to join me later for a deep dive into the state of private credit. Don't miss that conversation to come on your Bloomberg Brief. The Biden administration is considering to ramp up its chip crackdown on China. Bloomberg has learned that the U.S. has floated using the most severe trade restrictions available if companies like ASML continue to give China access to advanced semiconductors. Now, that potential risk, it is hitting ASML shares this morning, down 6%, even though it reported earnings that beat in order intake last quarter. For more on this, let's bring in Bloomberg's Sarah Jacob, who joins us now from Amsterdam. Sarah, what do we know about this chip crackdown in terms of, I know it's being described as really severe, but exactly how severe and how might it affect ASML?
Good morning. Yes, second quarter bookings rose, but geopolitical risk is certainly front and center this morning. My colleagues had an exclusive story on how the U.S. government has told allies that it's considering using, as you mentioned, the most severe trade restrictions available if companies such as ASML and Tokyo Electron continue to, give China access to their most advanced semiconductor technology. It's basically looking into a rule which lets U.S. impose controls on foreign-made products that have even, the tiniest amount of American technology, and that will surely weigh on ASML. The goal is to persuade allies who've already, restricted some shipments to China to limit their company's ability to repair or service this gear that's already found its way to China.
Sarah, how does the politics intersect with this? Because, correct me if I'm wrong, but it's also a new Dutch government, and we might possibly be having a new U.S. government.
Yes, it's a new Dutch government which has been sworn in, and a new cabinet has been formed. We've not heard anything particularly from the new government on their policy yet. And it waits to be seen how the new administration in the U.S. also, whether they, push forward with these restrictions. So far, what we've heard is from the Netherlands government is they're waiting to watch what happens once a new government forms, and then they're going to take it from there.
Did ASML in their earnings say much about the politics? What were your takeaways, not just from their earnings, but the outlook that they gave?
No, there was no reference in terms of geopolitics per se. Of course, in the second quarter results this morning, we know that order intake beat, and that was largely about, driven by the artificial intelligence boom that we're seeing. As we know, ASML has a monopoly in making, equipment which is used to make the most advanced chips, and so they're really benefiting from this. China, of course, remains ASML's largest market. It accounted for nearly half of ASML's second quarter revenue. In terms of outlook, we're seeing that they continue to see 2024 as a transitional year before they hit 2025. They've sort of reaffirmed their guidance for 2025 and 2030 in terms of revenue and margins. They did, however, offer an outlook for 3Q sales, which was lower than expectations. And the company said there are still uncertainties in the market, which is primarily driven by the microenvironment.
Sarah, really appreciate that update. Sarah Jacob in Amsterdam. Okay, coming up, we're going to take a look at what else is making headlines around the world. We'll give you the context that you need on your Bloomberg Brief. This is Bloomberg Brief. I'm Danny Berger. Let's get you some front page news, a look at what's making headlines around the world. First up on the front page of the New York Times, Senator Robert Menendez was found guilty in a scheme to sell political favors. The New Jersey Democrat accepted gold, cash, and other payoffs in an international bribery scheme, which, by the way, he had initially blamed on his wife for keeping the gold. He was found guilty on all 16 counts. He is the first U.S. senator found guilty of acting as a foreign agent. Next up, the FT has this. released that PwC has lost 2/3 of its accounting revenue from its mainland China-listed clients. More than 20 clients have switched firms, with PwC bracing for that fine in connection with its Evergrande audit that will amount to $77 million, that loss of clients. Partners were told to, quote, embrace the turbulence. Next up on the Washington Post, they're taking a look at President Biden's plans to announce support for major changes to the Supreme Court. That would include term limits on justices, enforceable ethics codes, also trying to get rid of the immunity for presidents that they ruled in their last ruling. The changes, though, are unlikely to get far in a divided Congress, but there's the sense of putting out this policy that Biden had long resisted despite calls for it ahead of the election, with Trump taking up a lot of the air, really trying to appeal to his base. We were also talking about that chip crackdown as sort of another policy announced in anticipation to the election. Okay, a quick check on your currency market this morning. The dollar weaker across the board. Sterling getting a boost after hotter inflation services data. Meanwhile, the yen, this is the one to keep your eye on, gaining more than 1.1% versus the dollar, trading at 156. Trump was talking about a desire for a weaker dollar versus the yen in an interview with Business Week yesterday. We'll discuss that with T.S. Lombard coming up. From our global headquarters in New York, I'm Danny Berger. Managed Cranny is off this week. Let's set your agenda. The big take on Trump. The former president says if he wins, he'll allow Fed Chair Powell to serve out his term. Plus, more from Business Week's exclusive interview. Taking a breather, stocks retreat after hitting yet another all-time high. The great rotation continues. The Russell 2000 beats the NASDAQ 100 by the most in a decade. And big banks see strong M&A as it closes out the earnings season. We're going to discuss the private credit environment with Blair Jacobson of Ares Management in the next 10 minutes. All right, the great rotation, the statistics are abound with how you want to describe this. By one measure, it is the biggest outperformance of the Russell 2000 versus the S&P on record. We are in historic territory as everything goes right for small caps, be it the economy, the perceived soft landing, and a Fed that's going to cut, and the politics. That continues this morning with the Biden administration reportedly weighing the most severe possible chip restrictions for those exporting to China. You can see how that's playing out. S&P 500 futures down by nearly 0.1%. NASDAQ 100 futures underperform even more, off by more than 1.33%. And again, the rotation is here. Russell 2000, we are still buying up 0.1%. Meanwhile, the yen is gaining with some speed. Basically, most currencies versus the dollar are gaining this morning. For the yen, it's an appreciation of 1.2%. Trump talking about how he wants weaker currencies, a weaker dollar versus other currencies, that the yen and the yuan unfairly weak, really talking about that desire and tariffs in his interview with Business Week. Now, to that point, T.S. Lombard's Freya Beamish weighs in on the risk of a second Trump presidency, writing, quote, Trump's policy program is incoherent, making forecasting difficult even before we get to political risk. Many of the things he likes, tariffs and American international withdrawal, would in the first instance be pro-U.S. dollar. Freya joins us now. She's chief economist at T.S. Lombard. Freya, it is a confusing time because it is policies, as you lay out, that are pro-dollar, but Trump himself is not pro-dollar. So how do you think about the greenback next year?
Yeah, the way we think about all of these issues is through the idea of pressure. So we're in general, we're pro economies where there's a buildup of pressure in the system that is going to help wage growth to come through, and that wage growth is going to unlock capex, and that's going to unlock companies will have to do what's called learning by necessity. And this is all going to give us the secret source of a healthy economy, which is productivity growth. So that's what we're looking for. But the problem is that pressure requires strong institutions. So the thing that stops a high pressure economy from spiraling out of control and kind of bursting its seams is strong institutions, like strong kind of independent central banks, and kind of forecasting in the UK case, the OBR, the US case, the CBO. These are the kind of the barriers between that high pressure, which can be a very benign thing, actually tipping the economy over into a high inflation regime where the dynamics are very, very different and it's a much more volatile system. So the problem with forecasting Trump at the moment and assuming that he's actually going to occupy the White House is that a lot of his program is kind of pro-dollar. So if you tariff other economies, we know that from kind of theory, but we also know that from the kind of the previous rounds of tariffs. The renminbi is going to depreciate if he puts those tariffs on. The problem is, though, Trump is going to turn around and say they're manipulating their currency, and that's the moment when he's going to remind himself that he actually wants a weaker dollar. And there's a whole kind of host of the march of economic history that is pointing in the direction of politics really reaching that kind of impasse with the continued strength of the dollar. It's known as the exorbitant privilege, but it's starting to be seen as an exorbitant burden. And that's J.D. Vance coming in and kind of pointing in that direction as well. So the question then really becomes kind of what can he do to weaken the dollar? And that's a much more threatening thing to markets.
I guess let me ask that, Freya. What can he do?
So in terms of legally, we know he's kind of said he would allow Powell to stay in power. In his position, at least. There was an if in that statement, which is slightly worrying. I think in reality there is a high barrier to actually taking Powell out. There would be a legal challenge there, and he has previously just thought, okay, well, I'll talk about it, but I won't actually do it. So that's the hope that it would just be kind of jawboning, but he's not actually going to go for it. He can do more when it comes to the chair of the banking supervision, and that actually is a material part of monetary policy. That's legally speaking a different setup from the chair of the Federal Reserve. So he can do some things there.
If I can just jump in, because you also talk about this idea that I think is interesting, of the U.S. stepping back as the global police and what that means when risk-off events happen. I mean, Trump talking to Business Week talked about this idea that he's not exactly very keen on supporting Taiwan should there be a Chinese conflict because of its hold over chips. He's long said that he's not necessarily thinking of staying in NATO because he thinks Europe is treating him unfairly. So what do risk-off events, what do geopolitical events look like in the future for these markets with a more isolated America?
The U.S. doesn't even have control over global shipping anymore. This is a massive sea change. That wasn't intended to be a pun, but that is a massive sea change in global geopolitics, that there are attacks on U.S. on kind of developed market Western ships, and the only countries that respond are the U.S. and to some limited extent the U.K. I'm talking about the attacks in the Red Sea, and that's before you even get to the kind of the potential for hotter conflicts to come through. The problem that we have at the moment is that in the very short term, the policies that are coming through, kind of tariffing other countries, we're having a higher pressure economy, and that's good for stocks. But there's this sense that we're sort of teetering on the brink of a totally different international order. And that means that there should be a much lower average for cyclically adjusted PE ratios. If we look at the average since 1989, when the Berlin Wall came down, it's much higher. It's about 23 compared with the short 20th century in which there were two world wars and the actual Cold War. When cyclically adjusted PE ratios were down in the region of the 13. So somewhere in between where we are right now and that hopefully not as low as 13, there's a new average which Trump's policies could potentially push us towards. What that means for bond markets is that the term premium should just be a lot higher than it is right now. If there's a much higher increased risk of supply side, negative supply side shocks in that deteriorated geopolitical environment, then bonds are just a much less valuable hedge for equities, because that type of inflation shock is destructive of demand. So you have positive correlation between bonds and equities, and it's the bad correlation. It's not the one where they're both going up. So the term premium should be a lot higher as well. And the flip side of that also is that valuation should be lower. So that's the structural story, but the kind of where he's pushing things kind of cyclically, or where he's kind of promising to push things cyclically, is away from that story towards a more benign situation, which is just that high pressure that we've been craving for more than a decade.
I'm trying to think of how you price that in, Freya, because as you say, it's a high-pressure economy, and his policies would help that. But internationally, it's a new regime, which means that could be pressuring valuation. Right now, this market is just pricing the former, that it's a risk-on rally because you have the certainty of who might be president and some of the policies there. So what do you do with that? Because these are two opposing forces.
Yeah, there's commodities and there's defense stocks, which ironically are kind of a hedge for both the high pressure economy and for, if things do get pushed over that precipice. Every high school student knows how an arms race ends. So that's the kind of the downside risk. But if you're invested in defense stocks, then you're involved in that. But on the other side, it's a sort of a hedge because actually defense spending has a very high fiscal multiplier, and so it helps to build that pressure in the economy. So that's kind of a sweet spot in both directions.
Freya, if I can just jump in for a second, because I think we need to show everyone these pictures. You're in London right now, where the king is also getting ready for the King's speech. You can see his horse-drawn carriage leaving Buckingham on its way to Westminster. Well, he will lay out the speech written to him by the current government. 35 policies are expected. So this is kind of the pomp and ceremony portion of that with his horses and, again, his King's guards. Freya, again, a pivot here, but we are going to hear from the king and the policies that the Labour government wants to pursue. What are you looking out for today in the King's speech, if anything?
I think one kind of litmus test that people are looking out for with regards to the ability to break away from this kind of austerity light, which I think would be a good thing, again, building pressure, but being respectful of institutions such as the OBR and the Bank of England. One thing that people are looking out for is whether they'll kind of move away from the limit on two children in child benefit. So that'll be interesting to see that. But I think there's actually a lot that Rachel Reeves can do over the course of the next government to move the culture away from that austerity that became so embedded in the course of the 2010s. It's almost as though this kind of robot that is churning out the numbers, and we all have to kind of limbo under the fiscal headroom. And that's the target. We're actually coming back to the previous conversation and the increasing precariousness of the global dynamic.
Right.
If we're focused on the debt ratio now and in the next 5 years, we're probably missing the much bigger picture of what can happen to the debt ratio if some of these underlying issues, the hollowing out of the middle income section of the distribution, the undermining of democracy, if these things are not tackled, then the debt ratio will be 50 percentage points higher than of GDP within the next 10 to 15 years. So the dynamic needs to change, and it needs to change quickly.
Freya, really wonderful to speak with you. That is Freya Beamish of TS Lombard. And for more on what we've been talking about, what former President Trump has in mind for his campaign, don't miss the latest edition of Bloomberg Business Week with that exclusive interview with the Republican nominee. Okay, coming up, we're going to talk about the world of private credit with Ares. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger. So the big bank earnings, they are finished, and they flagged a stronger deal environment as they closed out the earnings season. Some of the notes we saw, JP Morgan logged its best M&A advisory quarter since 2022. You had Morgan Stanley's Ted Pick saying a resumption of more normal M&A activity over the next few years will come. And to round it out, Citi CFO Mark Mason said that the pipeline is quite strong. Here to break that down and just the general private credit environment is Blair Jacobson, co-head of European credit at Ares Management. Blair, so great to see you. Thanks for stopping by when you're in New York.
Thanks for having me on.
Bright and early. Look, so from your point of view, from the second half of the year, because obviously the banks are really enthusiastic, investment banking results were good. From the conversations you've had in your lens into this world, what does M&A activity look like for the second quarter?
So clearly you're right. The banks, maybe we've had about 6 announced earnings, really upbeat on investment banking revenue, advisory revenue, capital markets revenue. We think that's underpinned by 3 main factors. The first is the macro is good. Compared to where we were a year ago, there was a lot of anxiety. Will inflation come down? Will we have recession? Will rates keep going up? Fast forward to today, the outlook looks much better. Inflation's come down. Rates are either on hold or the ECB's reduced rates by 25 basis points. The economy's holding on. So M&A is a confidence barometer, and things look good for buyers and sellers. The second factor that we're seeing is capital markets have reopened. Since 2022, there was a lull in the capital markets, but 2024 will be looked at the year when they have reopened, first in the U.S., now in Europe. Loans and bonds are being syndicated by investment banks. CLOs are being formed to acquire those, and all of that underpins transaction activity. And the third major factor is what we call the overhang. There are $3 trillion of assets held by private equity firms that need to be sold. It's been delayed by COVID, and frankly, LPs are still asking for their money back. They're asking for DPI. And there's also about $1 trillion of capital that needs to be invested within a time frame into LBOs. So when you add up those three factors, we think the outlook for M&A looks pretty good for the rest of the year.
And I mean, you mentioned the rate environment. This I'm interested in because the cuts that we have seen, it's sort of this stop-start sort of thing where the ECB cuts 25 basis points and then they just wait it out. We're still waiting for Fed cuts. What difference does that make for your world? Because at the moment, this is a public bond market that's really gearing up for Fed cuts. Has it done enough to awaken the animal spirits in private credit?
So let's take a look at where we are. Rates started going up in the UK at the end of 21. The Fed moved in early 22. The ECB in the summer of 22. Fast forward 2 years. Actually, the ECB, as you said, cut first by 25 basis points. However, the rest of the central banks are on pause. We view the ECB's cut as largely symbolic. It hasn't had any real impact yet. But what they're saying is inflation has come down from 10% to 2%. We're obviously no longer on pause. We are in a cutting mindset. So the question really now is when, not if, they will be cut. So what does this mean for us?
Yeah.
Again, with floating rate assets, we're in a good place. If you look at the forward curve, the 3 year is actually 100 basis points lower than the 3 months. So there is a view they will be going down. And again, when there's this tension between rates and transaction activity, we think this will be a positive catalyst in the near to midterm.
Of course, a lot of the criticism of your industry, to be clear, not Ares specifically, but the industry as a whole, is that some people have been in this extend and pretend mode, that they just needed to wait for rates to come down because they have portfolio companies who are feeling the strain from that floating rate debt. To what extent do you see that as true, and the rate cycle that we're in right now enough to sort of help those that might be in trouble?
So the good news is that the underlying performance of portfolio companies has been strong. You know, we invest in businesses that aren't very correlated to GDP, that have good underlying growth. So the underlying companies are doing well. Is there some strain on capital structures if those businesses hadn't hedged rates? Yes. However, again, we've had high rates for some time. That's been digested. And certainly with rates going down, that leads, as we said, to more transaction activity and certainly more refinancing activity.
So it's an overall healthy market. But if you look at fundraising, funds with less than $1 billion of assets received the least amount of cash on record last year. Is there just no place for newcomers anymore in this market?
Well, it's really tough. We see big benefits to scale in our markets. Larger managers have more people, they see more deals, they get more information. They then log better investment performance, which helps attract assets. Smaller players, it's really difficult. And from a limited partner perspective, think about the end investor's perspective. They are consolidating their relationships. They want fewer relationships that are deeper, long-term in nature. There can be efficiencies there with respect to cost and performance. So I'd say that the entry barriers for new firms is really quite high at the moment.
What does that mean for the getting bigger in terms of regulation? I mean, do you think regulators look at this, both, across U.S. and Europe? I know the SEC specifically pointed out concentration risk, the head of the SEC, in concerns for private credit. But do you think there gets to be like a big to fail sort of flavor that worries regulators?
So we're always mindful of regulation. And for example, we've been regulated for a very long time by the Securities and Exchange Commission here in the U.S., by the FCA, in the UK and across Europe. So this is not new information. And the drum's starting to beat a little bit louder. The Bank of England started a review in Q4 of last year. We've had contact with regulators. We're very open and transparent. But actually, we welcome that dialogue. We firmly believe that private credit is a force of good for the economy, especially as regulation is actually making it more difficult for banks to hold these assets on their books. They need to go somewhere. And in some ways, we're the new banks. We have the originators outsourcing credit, and our end limited partners, whether it's sovereign wealth, pension, insurance, are holding the assets. So again, we welcome these types of discussions.
Well, the irony, though, is banks are trying to get back in, and they're doing so not on balance sheet anymore, but off balance sheet. Goldman Sachs raising $20 billion for their private credit fund earlier this year. I mean, these are big numbers. What does that competition mean for you?
So I think that more elevated banks, and by that, first I'll talk about commercial banks, view partnering with firms like us as the way forward. Again, they don't want to necessarily hold the individual loans on their balance sheets. They would like to maybe source those loans, partner with groups like Ares, finance our funds, for example, or engage in SRT-type transactions to get those assets off their books. Banks that have been raising capital, usually it comes from either institutional clients or retail clients. There are actually very few banks that we think can do that successfully. And when you're dealing with such a large market, we don't think it really moves the needle very much.
But we have to talk about politics because it's the only thing dominating this news cycle right now. Your favorite, I know. Well, you sit in London, and I mean, the UK oddly has become maybe the most sort of non-volatile place. But we learned that politics is volatile right now after the European parliamentary election. Is there a sense that your portfolio companies, and sort of more broadly, that this is an environment where people are putting off investment decisions because of the political volatility?
So let's talk about where we are. This network has reported many times this is the biggest election year that we'll see in our lifetimes. Half the adults in the world will be voting. And July was a very, very big month, both in the UK and in France. In particular, in the UK, where I live, the result was expected. We had a conservative government for 14 years. Now it's Labour's turn. They do have a majority. Even though voter turnout was weak and Labour only has 35% of the vote, they still have a mandate. You mentioned earlier that the King's Speech is today, so we'll learn a little bit more about what their plans are. But what's interesting is this Labour government is not the Corbyn Labour government. Starmer's been very centrist. He's actually reached out to business. He's saying all the right things. He wants to invest in the country, the infrastructure, the rail, the housing, digital infrastructure, for example. However, what everyone wants to hear is how will this be financed and paid for? And for that, we have to wait until September when they announce their first budget.
You're going to say everyone wants to know what he's going to do with the carry taxes.
Well, that's also quite topical as well.
Yes, it definitely is. Are you concerned?
I think there will be some change. I mean, again, this has always been discussed, but again, it's a matter of degree. And I personally don't think people make their minds up based on tax policy. I think people make their minds up based on where they want to live and where they want to work.
Fair enough. Blair, thank you so much. It was really wonderful to catch up with you this morning. Blair Jacobson, the co-head of European Credit at Ares Management. Okay, coming up, we're going to set you up for your trading day on this Wednesday on your Bloomberg Brief.
This is Bloomberg Brief. I'm Oliver Crook in London. Let's have a look at the day ahead and what you need to pay attention to. Johnson & Johnson earnings out before the bell. United Airlines reporting after the market close. Plus, we'll get the latest U.S. housing data at 8:30 a.m. Eastern Time. And we'll have more Fed speak throughout the day, hearing from Barkin, Waller, followed by the Fed Beige Book at 2 p.m. Eastern Time. Let's take a look at the markets heading into the session here in the United States. S&P futures down almost 1 percentage point. You can see it there, 75 basis points. NASDAQ down 1.25%. That is down to a tech story, a broader sell-off in the semiconductor space, which we'll get to in just a second. And you've got cable up there, 130 on GBP USD, up almost 1 percentage point. That has really undone the trade that we've had from the last year, breaking through that 130 level the first time in over a year time. Taking a look at the chips this morning, ASML down to the Biden administration looking at restricting semiconductor production in China.